People are always asking me, how do you manage risk in Bitcoin? And so, what came to my mind is it's options contracts. And options contracts were built to manage risk. They were not built as speculative tools. They were really built for producers and consumers of commodities to manage price risk on an underlying asset. Bitcoin is a commodity, right? So I wrote this book called Bitcoin Options, Energy Storage, Risk Management, Real Yield. And what I do is I get in there, I say, first off, what is Bitcoin? How is Bitcoin a commodity? What is money? Which is really the answer or the question that Bitcoin is answering. So we start with that, and then we talk about risk management. And I'll get into this. There's something called a call option. You own Bitcoin, right? And you can sell the obligation to sell your Bitcoin at a higher price than it is currently today. I'll give you an example. Bitcoin's at $68,000. I can go sell a $78,000 strike call option that expires on October 27th, 2024. I can collect a premium yield for selling that option, and now I'm obligated to sell my Bitcoin at $78,000 on the expiration date, and that allows me to generate some yield. And the risk management component there is I can take that yield and I can go buy protection in the form of a put option at zero cost. So for example, Bitcoin's trading at $68,000, I sell the $78,000 call strike, I can then go buy, let's say, the $60,000 put option, which gives me the right to sell my Bitcoin at $60,000. It's a very interesting structure for someone who's long Bitcoin because you have upside to $78,000, right? And you have the right to sell at $60,000. This is a very common strategy in traditional finance, and we're trying to bring this into Bitcoin. There's another way to think about this. I just told you about how to sell a call option and buy a put option at zero cost. I'm now going to tell you about selling a put option to enter into a Bitcoin position. When you sell a put option, you are obligated to buy at that strike price. The buyer of the put has the right to sell at that strike price. So, for example, if I have dollars and I want to buy Bitcoin, I can sell the $60,000 strike put option that expires on October 26th. I am now obligated to buy Bitcoin at $60,000, and I get paid a yield in Bitcoin. We call this a cash secured put. And this is becoming a very common strategy for hedge funds, for asset managers, proprietary traders, and really just investors to come into this marketplace. To take that strategy a step further, I've sold the $60,000 strike put option. I've collected a yield for that obligation to buy Bitcoin at $60,000. I can take that premium and now go buy call options at zero cost. The exact opposite of the strategy I talked to you about prior, and we call this a risk reversal. So now I'm obligated to buy Bitcoin at $60,000, but I have now purchased the right, let's say, to buy the $78,000 strike call option, which gives me upside exposure to the worthy asset to appreciate in price. So I cover all this in my book, Bitcoin Options. Check it out, it's on Amazon. And my company is BlockFills. We are always happy to talk to anybody about risk management and real yield opportunities in Bitcoin.